over the next, say, 5 months or so, next 2 quarters, you're going to see silver in the 60s to 70s
Oh, wow.
in the surge, this surge. Now,
Yeah.
that's not the top. I'm not arguing that's a top. I'm arguing in this particular surge that is just beginning, I think you could see us well above the old 50 highs up into the 60, 70 zone before you even pause. Now, I'm just looking at this leg that is beginning to unfold. And I think it's going to blow past that silly high at 50 and the other high back in 1980 at 50,
Yeah.
which is, they're sucker highs. They're ridiculous. In
Yeah.
real dollar terms, we'd have to be probably $200 or 300 just to match those highs.
Silver's resurgence in 2025 has become one of the most closely watched developments in global markets, with prices climbing over 27% year to date and now approaching $36 per ounce. This impressive move places silver at its highest level in over a decade, renewing strong interest from both institutional investors and private holders. Unlike the speculative spikes of the past, this rally is being driven by tangible, long-term forces, especially rising industrial demand tied to renewable technologies, electrification, and supply constraints. According to Michael Oliver, a well-regarded momentum analyst, the recent breakout above major resistance zones indicates a structural shift is underway. He views this rally not as a short-term surge, but as the early stages of a sustained trend built on fundamental and technical strength. Silver's price behavior over the past year reflects a market that has broken free from a decade-long ceiling, notably the $30 zone, which has acted as a barrier since 2011. Michael Oliver points out that the recent movement is consistent with an orderly, technical advance, not a speculative blow-off. Momentum indicators suggest the market is entering a new leg higher, one that could extend significantly over the next few quarters. Silver has quietly emerged from years of consolidation, and with its breakout from long-standing congestion levels, the stage appears set for higher valuations. Analysts monitoring price cycles and intermarket correlations now see silver heading toward the $60 to $70 range before a meaningful pause, a move that would surpass previous historical highs and signal a revaluation of silver's role in the broader monetary and industrial systems. Looking forward, the consequences of silver's upward trajectory could reshape its perception among global allocators. As confidence in fiat systems continues to erode and inflation remains persistent, precious metals are regaining appeal as long-term stores of value. If silver begins attracting even a fraction of the institutional flows currently directed at gold, the impact on physical supply could be substantial. With global minting capacity already limited and inventories tightly managed, any sustained increase in demand could quickly translate into shortages. In this emerging environment, silver is no longer just a speculative trade. It is becoming a core component of financial defense, with 2025 potentially marking the start of a broader shift in how the world values real assets. Now, we present the clips from Michael Oliver's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
It's not that they're buyers so much as that they're going to be printers. We know that every time there's a hiccup and gut pain, they come in and they print, they expand the money supply, they lower interest rates beyond reality, and they create monetary stimulus and therefore further sharp degradation in the money unit you use to measure your assets. So the gold price will continue to move inversely to the degradation in the money units. And we see these other factors we've been talking about, like a bond market in jeopardy, government bonds in particular, not mortgages this time, and the stock market bubble, especially here, as being factors that will spark a central bank into panic mode. Now, remember, even if Powell tries to stay tough, and he's going to find it very tough to stay the way he is between now and when he leaves in January, because a lot of shit's going to happen between now and then. It's going to force his hand. Otherwise, the public will be marching outside the Federal Reserve building. Gold knows that. Gold knows what central banks do, and that's why it lives. So if we have another downside in these other assets that your guest, your subscriber mentioned, that will further impact the central bank into doing exactly what benefits gold, namely degrade the money unit rapidly. So that's why if you go back and look at the 70s or look at these bear markets that occurred in the stock market, Gold went up during those times. There's like a few exceptions of a month here and there where it went down with the stocks. But generally, it goes opposite to the stock market in bear trends. Why? Because the central bank is going berserk during that time. This time, even more so. We'll have to. So I think gold knows that. So I think, no, I think the drop in those categories is bullish for gold.
Okay. All right. So they're buying real money, gold, and they're printing currency.
Yeah. Yeah.
Dollars.
No, well, I don't care whether they're buying it or not. I mean, somebody's buying it, whether it's the Chinese or somebody else, or finally the Western public starts to buy it, which I understand is increasing too. But the reality will force the buying, and I don't care if it's central banks or not. They don't control markets, frankly. If they did, we wouldn't have boom bust cycles. An investment public, which is getting more shaky about the stock market, and asset managers who've got their heads screwed on right, are looking at places to be within the stock market that are not performing in an uncertain way. And I think gold miners have slapped them in the face recently because gold miners have suddenly grown a backbone, which we expected. Yes, I think miners are a better place to be than gold. I think they could double or triple the performance in gold over the next year or two, which whatever gold does, triple that on a percent basis for miners. And there's technical reasons for that. And I think silver could outpace them both, big time, on a percentage basis. In fact, I think this move in silver right now, you paused here at 37, which of course has taken out a bunch of highs. Yeah, you can see the distribution highs up there at 35, 35, 35.
Yeah.
You don't ultimately top that way. You might pause there, but you don't top. You generally spike when you make a major high. You go back to the 2011 high. It was gaseous.
Right
You didn't. Once you made that high, you collapsed. You never get back to the high again.
Yeah.
I mean, you collapsed the first few months off the high, came back, but you could never get back to the high.
Yeah.
And it was gaseous. It was hardly even a high. The reality up there above the mid 45 level or something, it was temporary. This time we've just come out of congestion, and you'll notice if you draw a line through the lows in 2011 and 12, where silver pulled back to about 25 there, going up, the lows that occurred, right there.
Oh, right. These ones right here?
Yeah, right there.
Okay.
Find the low close in there. Go up a little bit further. The low monthly close in that zone. You'll see a bar there. You go up a little bit further. Take that line up, your line up. The red line's here. Right up a little bit. Take it up. Yeah.
This one?
No, take it down some now. Right about the stop. Yeah. Move your solid line up a bit.
Low is 26.10.
No, the close. You'll notice
the close is 27.
Yeah, and if you'll look over to the left, you'll see another close at about 27 something.
27.75.
Yeah, I know. Even back and further, there's a bunch of closes there. Now, if you go horizontally, look at the recent action. Look where that line intersects. We stopped basically at that upper 20s repeatedly there in the 2021, et cetera. Finally broke through it. So you broke through a price level even that said, hey, man, wake up. You just went through a major pivotal zone. And again, we've not behaving like a blow off top. We're just emerging from congestion.
Yeah.
Our assumption is over the next, say, 5 months or so, next 2 quarters, you're going to see silver in the 60s to 70s.
Oh, wow.
In this surge.
Yeah.
Now, that's not the top. I'm not arguing that's a top. I'm arguing in this particular surge that is just beginning, I think you could see us well above the old 50 highs, up into the 60, 70 zone before you even pause.
Huh. Okay,
Now,
so
again,
you're
not
kind of
a-
thinking we're like here, right? You're
Yeah,
thinking like this part of the pattern is kind of like
That's
this.
it. Yeah, and about if you'll look there at about half a dozen months you left the earth. Okay, now then you topped. I don't think that's going to happen this time.
Okay.
I think you're going to. I've got friends and associates that think you go to $200 wouldn't shock them, and they're fundamentally astute folks. I won't mention their names. You probably know them. I fully agree, but right now I'm just looking at this leg that is beginning to unfold. And I think it's going to blow past that silly high at 50 and the other high back in 1980 at 50.
Yeah.
Which is, they're sucker highs. They're ridiculous. Yeah. In real dollar terms, we'd have to be probably $200 or $300 just to match those highs in a real dollar value.
There's been a lot of printing since then.
Yeah, I think so. So silver's catching up, and I think it's going to vastly outpace gold.
The US dollar is now exhibiting clear signs of structural weakness, having broken below long-term support levels that had previously anchored its position in global markets. This decline is not merely a technical dip, it reflects deeper macroeconomic imbalances, including record fiscal deficits, soaring national debt, and fading demand from foreign holders of U.S. assets. The erosion of confidence in the dollar's stability is prompting a strategic reassessment among global investors and central banks, many of whom are shifting reserves into gold and other real assets. The dollar index, long seen as a gauge of strength against other fiat currencies, now tells a different story, one where its relative position masks a broader, more concerning trend of systemic devaluation. This backdrop has major implications for the trajectory of gold and silver. As the dollar weakens, the appeal of precious metals as stores of value increases, not merely as hedges, but as monetary anchors in an increasingly unstable financial landscape. Gold has already outperformed the dollar over the past decade, and with the greenback now entering a deeper downtrend, analysts expect momentum in gold and silver markets to accelerate. A rapid decline in the dollar could act as a spark, triggering widespread reallocations into physical assets, just as global supply chains tighten. If this downward pressure continues, we may be witnessing the early stages of a broader monetary shift, one in which the dollar's dominance fades and tangible stores of value regain a central role in portfolio construction and global trade settlements.
My own personal investments are in silver miners, and also GDX, which also contains about a half dozen major silver miners, by the way.
Yeah.
It's not just gold miners. It says gold miners ETF, but there's some big silvers in there. Same with XAU index, has quite a few big silver miners in it. I suspect that the juniors, SALJ, for example, will suddenly get hot a bit later. And that's usually when the let's say, they're cheapies, okay? You can buy them for 50 cents, $1, $2, that kind of thing. It's when the average Joe investor who's not been in the gold miners thought it's a bad place to be, which in fact it has not been, despite its seeming irregularities in its price movement. It's actually been better than gold, as we've measured. They'll suddenly say, I want to get in there. And they're not going to want to buy a $100 stock or a $50 Newmont or an $80 Newmont. They may go in for a handful so they can buy thousands of shares of some juniors. And frankly, I think at that point, the juniors will become hot because the big miners at that point will start buying them up. But I think it's slightly lagged to where we are right now. It would be my best guess, is that, yeah, the juniors will get hot, but probably a bit later. Now, we also measure on a spread basis, a relative performance basis, like SIL versus GDX, silver miners versus GDX.
Okay.
And they haven't quite broken out yet, but there is a spread relationship there that shows a pending breakout of pretty dynamic proportions on a relative performance basis.
Is this
what you got?
what you mean? I got SIL divided by GDX?
Yeah, and if you put that on, we look at like monthly closes instead of intra-month spikes and so forth. But anyway, there is a structure there that you can see on the spread chart, a trend structure that has been negative for SIL relative to GDX.
Yeah.
But if you notice over the last couple of years, it stopped.
Yeah.
Silver miners basically went and took out that low in 2019-20 that it made there at the 0.91% level. Do you see that sharp drop in 2020?
Oh, yeah, right here.
Over there. You got below, but you got back above it. And in other words, you're basing. And momentum of this spread says, yes, you're basing. And it won't take much firmness this month or next to break the spread out on a momentum basis versus GDX, saying, now it's time to shift over to the silver miners. And I think that's likely to happen. I'm betting personally. I'm buying some of the major silver miners.
Okay.
Anyway, that's my emphasis. We look at the dollar index as a separate, it's a major category. It's a big mover, okay, because it's also the euro and the yen. The other side of that is 70% of the dollar index. Mm-hmm. Yeah, punch that guy up there. That's the dollar index. You can see it's been in a layered decline for decades.
Yeah.
Big drops, big rallies, big drop, two big waves down since 1983. And boom, and a boom. Okay. And lower highs and lower lows. So, okay. Now, even the price has nipped out the last few years' lows. If you can focus more on that there, just the last
few years.
You can see we made lows, and after the high at 115, we collapsed down to 100 level in 23 and 24, and we kept getting buyers there, 100 level. rally, 100. It was really a non-event. In other words, you were in like a 7% range for a couple of years there. Across that, yeah.
Yeah.
They played a price game. They tried to break out upside late last year, early this year. We said it's a bull trap. Don't trust the breakout. Sure
Yeah.
enough, in March, which is in the middle of that range there, you'll find it 104 close in March,
Yeah.
which is go over to the right.
That's October.
No,
Sorry.
this March, 4 months ago.
Oh,
Right there, that month, we
there,
got
right there.
bearish there. We said, okay, that's it, it's over. Dollar index is going down now. Major trend. Now, even price has followed through since then and broken through the price lows at 100. You had a rally back to 101 after reaching 98 a few months ago. Went back to 101. Now you're back down. You even got into the below 98 in this month. Okay, but you're below that broken structure, groping. Now, there is another level at 98.35.
Yeah.
That's a 10-year moving average of the dollar index cash. It happens to be a momentum trend structure that goes back decades. When you plot an oscillator of the dollar index versus its 10-year average, you'll see there's like a multi-point uptrend that we will crack and close below if you close at 98.35 any month this year. We've traded below there. Right now, we're slightly above it. End of the month. You do that, and our last floorboard comes out. And at that point, I would say the dollar is probably headed back down into the 70s. Okay, now, the question is, what does that impact gold? Well, right now, at the current price, if you get that 98 level, you go back over to the left in 2015, where you go there, that big surge.
Yeah.
We forecasted that bull trend would get bullish in 2012, and it got up to 100. We thought it would get to 100. It did. Went ultimately higher. But in December of 2015, when gold bottomed, the dollar was where it is right now. Draw a line straight across. You're nowhere. 10 years, it's gone nowhere. Okay.
Yeah.
Yet gold is quadrupled. Okay. So the people that think, well, the dollar has to impact gold. Well, sometimes not. It's the ongoing overall degradation in money units, not just the dollar. And its real value degradation could be different than the dollar index. The dollar index merely measures it versus other degrading currencies. It doesn't measure the dollar versus its own money growth. Okay. But anyway, so net price to net price, I don't know that there's a great correlation. However, if you get a dynamic down move going in the dollar, that will no doubt help gold. It will be further wind at its back. It's not a pivotal thing. Again, gold is quadrupled, dollar's gone sideways. Okay. But I think a further drop here will exacerbate the situation, will also create wave effects in other markets when the dollar breaks. For example, foreign investors who own what? A lot of American stocks, more so than in history, foreign investors have come into our market. And two, foreign owners of U.S. government treasury bonds.
Yeah, the bonds.
They're affected by dollar movement too. U.S. investors like to forget the fact that the real money unit is degrading, but when they get out of their dollar-held asset and put it back in yen or back in euros, they've had another shin kick. Not just the decline in the U.S. stock market, but the decline in the dollar. So it's a wave impactor, and I think it's about to become active.
Okay.
As a noisemaker.
Okay. So if we see the chart do that, then gold is going to do the opposite and do that.
Yeah, no, I think it'll just help gold accelerate. I don't think it's pivotal because again, gold is 3.5-fold right now versus where it was at the low in 15. So you can't say there's a great correlation, but I think a speedy move in the dollar, which I think will begin without even getting back to this month's lows, will help gold.
While gold is primarily an investment and jewelry metal, silver serves dual purposes, with approximately 80% of demand coming from industrial applications. This makes silver prices potentially more responsive to economic activity while maintaining the characteristics of a precious metal investment. Looking forward, silver's unique positioning is likely to drive significant price appreciation as demand accelerates from sectors such as solar energy, electric vehicles, and electronics manufacturing. If the global economy enters a phase of technological expansion alongside persistent concerns about inflation and the stability of fiat currency, silver may not only retest its historical highs, but potentially surge past the $50 mark and move toward the $60 to $70 range. Do you think silver prices could break past their historical highs in the coming months as industrial demand and investor interest continue to surge? Share your thoughts in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.